Hello everyone, my name is Paul Craik. I'm the founder of View from the Peak, and it's my pleasure to sit down with you today and the guys at Real Vision TV and share some thoughts on the investing landscape over the course of the next year or so. The topic I'm going to discuss today and the title of this presentation is that momentum investing is dead, and what we're looking at is the myriad of headwinds but tailwinds that exist in global asset markets over the course of the next 12 months and beyond. I want to talk about the myriad of headwinds, I should say, that exist in the world at the moment. We know a lot of them, but I think it's worth elaborating on them just to give a framework on why asset markets are capped even in this negative and zero interest rate environment that the world faces today. Look, the number one problem that we face around the world is a lack of aggregate demand. Global growth is terrible. And you have anemic growth in the US. We know the problems that Europe and Japan faces. We had what I think is a false start in terms of a rebound in Chinese economic activity in the first quarter of this year. And as the article in the People's Daily around 2 weeks ago on May 9th indicated, the Chinese leadership is very, very concerned about the current debt dynamics in China. So any thoughts or hopes of a large credit-fueled stimulus from Beijing is really barking up the wrong tree. So Chinese growth is going to continue to be a drag, and as a result, aggregate demand globally is going to be poor. The second thing we need to focus on, which is very much related to a lack of global aggregate demand, is the fact that global profitability remains very anemic indeed. Pick your sector, be it energy, be it technology, be it US consumer. The world is struggling to earn profits. And that is not helped by a poor economic outlook, despite the loosest liquidity conditions that we've really seen in history. Thirdly, is stretched US equity and credit valuations. Putting the energy sector to one side, finding stable growth in the United States is difficult and very, very, very expensive. That said, as I'll elaborate in our discussion on tailwinds, the valuation floor that people will use to buy global equity markets, and in particular US equity markets, is significantly higher than most people actually anticipate. The fourth section and the fourth reason for global headwinds, and certainly the most complicated, is what I'll broadly describe as China. And we have a problem with Chinese growth, we have a problem with Chinese debt, and we have a problem with a newly quasi-freely floating Chinese currency. Chinese growth outlook is, I think, probably the cleanest problem that we face, i.e. we have been on a glide path lower really now for the last 4 to 5 years. And we have these mini cycles, these mini fits and starts. We had one in Q1, but they're not sustainable. They proved to be nothing more than short-term inventory rebuilds. And we have the basic problem in that Chinese growth is transitioning away from credit-fueled fixed asset investment. We know this, right, to a more sustainable consumption-driven economy. Unfortunately for China, and more unfortunately for the world, is that no one wins outside of China in a world dominated by Alibaba and Ping An Insurance. Brazil doesn't care if the Chinese buy more insurance policies. Indonesia doesn't care if more Chinese are going to the movies or buying stuff online. It's not where the global infrastructure is set. It's not what it's set up for. And at the end of the day, the emerging world is still very, very dependent on Chinese fixed asset investment, and that is in structural decline. Chinese debt is the most complicated topic that we deal with in financial markets globally. I'm in the camp that we are not in a crisis mode. China has a lot of debt. We all know that, but we can't just bucket Chinese debt into one very, very simple generic pod. It's a myriad of different styles of debt. It's a myriad of quasi-sovereign, large cap SOEs are, despite huge levels of indebtedness, are probably as close to a sovereign bond as they can be. And I think that we really need to delve into detail about what the true Chinese debt dynamics are. This is too broad a topic for today's discussion, But at the end of the day, China does need to get its aggregate debt levels down, and this will be a structural drag on growth going forward, even though the Lehman-style moment that many are espousing is really not going to occur. China also has the added difficulty of having to deal with a new freely floated currency. We know it's a dirty float. It's a quasi free floating currency at best. But since August last year, when the PBOC, in a means of appeasing the IMF to obtain acceptance into the SDR basket, the China went to a more floating exchange rate. And to be honest, it's had a lot of problems with that. It has had numerous headaches. It's had massive amounts of capital flight through the fourth quarter and early parts of the first quarter. A lot of that capital flight is explainable in regards to US dollar debt repayments and the like. But at the end of the day, China's internal infrastructure, its regulatory environment, is really not set up to have a freely floated currency. So we're going to see the PBOC need to continue to aggressively intervene in the currency. It's going to be something that is going to be an ongoing theme. But again, as with the debt dynamic, I don't really see a one-off disorderly devaluation in the renminbi coming. The Chinese have plenty of policy tools, both draconian and market related, to be able to stem the flow of capital flight. China, because at the end of the day it is a very authoritative economic/political model, it has the tools at its disposal to stop capital flight if it needs to. All linked to China is the fifth headwind that the world faces, which is structural oversupply in global commodity markets. Today's the 19th of May, and as we speak, there is a narrative floating around that global oil markets are heading towards deficit. I think nothing could be further from the truth. I think that oil prices have massively overshot where long-term supply-demand fundamentals are. And at the end of the day, the world is still facing a global commodity environment that is still looking at long-term Chinese demand and is grossly overestimating the long-term demand from fixed asset investment and the like. I don't care if we're talking about oil, we're talking about iron ore, we still have massive oversupply concerns globally, and at the end of the day, Chinese demand for most commodities, from oil to soybeans, is going to underwhelm global expectations. Sixth, and more structurally, is that we live in a global disinflationary environment. Blame technology, blame globalization, blame what you will. We do live in a world where there's very, very little inflation. This is not just a US phenomena, but we have structural deflation in China. We have Japan and Europe still mired in disinflation at best. And at the end of the day, it's very hard for me to see how we get out of a world where pricing power starts to reassert itself. If anything's been made very clear to us over the course of the last 6 years, is that quantitative easing was not the inflationary threat that everyone thought it was going to be. Sure, QE helped global economies via the wealth effect, but in terms of its ability to elevate price levels back to 2% targets, which most major central banks have around the world, QE was unable to do that. So we still live in a world without pricing power. We still live in a world where global wages continue to struggle, and that will continue to be a global headwind, I would argue, for generations to come. Number 7 is really the crux of all of this, which is a stronger US dollar, which is driven by tighter Fed policy. If you look at the world today, and I'll get into the whole concept of ranges being traded in the course of the next 5 minutes or so, but at the end of the day, the US dollar is going to remain structurally strong if the Federal Reserve is really the only major central bank globally which plans to raise rates. In fact, when you've got the BOJ, the ECB, the PBOC, all looking to ease financial conditions at the margin, it's very hard for me to see how you have a story where the dollar goes into structural weakness. This has created problems in regards to tightness in emerging market liquidity. It's seen really emerging markets underperform significantly for most of the last 2 years. Clearly, we've seen a bounce in our performance in the first quarter of 2016, which is more driven by the fact that the world was so structurally underweight emerging markets, commodities, industrials, and materials. Look, at the end of the day, tighter US dollar liquidity is going to remain a problem for emerging markets, and at the end of the day, that is the crux of the whole problem. So I think that we know these headwinds. I'm not explaining a lot of new things to you out there at the moment. But for those who are in the camp that emerging markets emerging markets in China could be the catalyst for a spiraling in asset markets, those who are concerned that the Japanese debt load is going to lead to a spiral in Japanese debt prices. For those of you who believe that Europe is a major concern, for those of you who believe that the US is going into recession and therefore global growth is on the verge of collapse, we all need to sort of just realize one fundamental thing, that there are 30 economies in the world that have negative interest rates. There are even more that have close to zero interest rates, and we fundamentally live in a world with no yield. Right? That has major implication for asset markets globally. If we had a thought back when QE began in 2008, would we have thought that we would have had the Japanese yield curve, most Japanese bonds out to 12 years have negative yields? Would we believe that German fixed income would be negative out 7 to 8 years? And in a world that has no yield, that hasn't dampened the desire for that yield. And what happens is that in a world with negative interest rates, you tend to find that risk curves flatten significantly, and that has real implications. So I don't care if you're a European insurance company. I don't care if you're the famous Mrs. Watanabe. I don't care if you're Rahm Emanuel, who looks at the Chicago teachers' pension plan and realizes that all he needs is yield. The world still faces a problem that it just has no yield, and therefore the price you pay for all assets, from sovereign bonds to investment grade, high yield, mezz, equity, commercial real estate, is all going to rise. A good example of this is we had a meeting with a Hong Kong-based property client that we have, and we were talking about Australia. Now, I know no one, including myself, who is optimistic on Australian property. Right. It's actually been one of the bear traps that we've faced over the course of the last 2 years, where people have been shorting Australian banks, shorting Australian property proxies on the back of weaker China, slower Australian growth. This guy was telling me that he is bullish on Australian commercial property. Haven't heard this in a long time, and I asked him why, and he said, because I can buy commercial property in Japan with a 2% cap rate. I can buy commercial property in London, in London, New York, or Berlin at a 4% cap rate, but I can buy Sydney cap rates at 6%. Right? That's why it's attractive. Right? That's why things like Australian banks, which should be much lower than what they are, continue to be bid because of a 7.5% dividend yield after tax. It's why German REITs have been bought aggressively. It's why Japanese REITs were bought aggressively even when the rest of Nikkei was struggling on the back of policy errors out of the Bank of Japan. It's all under the same sort of umbrella that, look, we don't do a lot of credit analysis anymore, but in the world that is flooded with liquidity like it is today, we have a situation where yield in all its forms is attractive. So what does this mean? It means that the price you pay for US bonds will go up and up and up, because Mrs. Watanabe in Japan is being sold 10-year fully hedged US Treasury structured products at 1.1% by their Nomura private broker. Private client advisors. It's the fact that you're going to have a continuation of very strong inflows from Europe, from Japan, from the emerging world into US Treasuries, because the US Treasury market is now one of the global high-yielding markets. It means that investment-grade bonds, for the highest quality investment-grade bonds, these companies will potentially be able to fund at negative yields, because there is such a shortage of bonds with the ECB participation, plus a desire for high quality corporates in all their forms. High yield is a very interesting area for me because if you take US shale and put that to one side, which given we have $50 oil has actually seen a lot of its problems being alleviated, the thirst for yield in all its forms continues to rise and rise and rise. And we can extrapolate this out to equities. The S&P is not going back to 15 times earnings because there's going to be buyers at 16, 16.5 and 17 times earnings into weakness because the alternatives are simply not there. There's buyers of, as I said before, there's buyers of commercial real estate around the globe. There's buyers of mezz finance, and across the risk spectrum, markets will continue to be structurally underpinned by this search for yield. Now, I can paint you a very bearish story on emerging markets. I believe that technology is going to rob emerging markets of its quest to maintain manufacturing within the emerging world. Real wages are going to fall on the back of that. And I can give you dire stories about China. I can paint the reasons, give you no real fundamental reasons to be long emerging markets. But at the end of the day, in a world where risk curves are flattening, where people are paying up for assets from sovereign bonds out to commercial real estate, there's no way that the risk curve flattens significantly and leaves emerging market yields sitting high up there. Emerging markets are going to be bought despite poor fundamentals. So where does that leave us? It leaves us with a world that is structurally underpinned but is trapped. It's trapped between the numerous headwinds that I alleviated to at the start, but it has these tailwinds of elevated valuation support in the negative interest rate world. This is not a great environment for tactical trading, because at the end of the day, most hedge fund investors have proven to be nothing more than short-term momentum seekers, and that just doesn't exist in the world that we currently live in. We have had some idiosyncratic overshoots. Oil is certainly one of them. But if I was to leave you with anything, upon looking at the time we record this, I think that oil is going to be 15% lower over the course of the next four weeks. We are stuck in ranges. I think we can define that range via the dollar. The dollar index has been, over the course of the last 15 months, stuck between, say, 92 and 100. And the reason it's been doing that is because when the dollar index gets towards 100, you tend to have had 3 rate hikes priced into the front end of the US interest rate curve 12 months forward, which is probably overly harsh and certainly much too hawkish. But on the downside, when the dollar index has got to 92, we've basically factored out all rate hikes, and when you have 0 rate hikes priced out 12 months forward, that too also seems unrealistic. So most asset markets remain trapped. The dollar's trapped, rates are trapped, emerging markets are trapped, commodities are trapped. And what you need to do is you need to be nimble enough to know that you have to be able to trade around those ranges. So, guys, that's really it from me. I think that in terms of idiosyncratic trades, credit wins over equity, because again, I know in this world of copious amounts of excess liquidity, the balance sheets are safe. I don't know how companies make money, but their balance sheets are safe. So credit wins over equity. Quality EM wins over lesser quality EM, with India being an obvious standout. I think that in regards to global growth versus value, you've got to pick your spots. US large cap tech is the first place that I look at. But again, you're buying this stuff into dips, and unfortunately for China, it is broadly uninvestable. So on the whole, I think that's it. We're stuck in a range. Sorry for you momentum types who would like to have a little bit of the gift that keeps on giving. Unfortunately, it's not going to happen. The only thing that breaks us out of this range is either a US recession, which I think is unlikely, or rapidly increasing inflation, which I believe is less likely. So until we get either one of those two, we're going to be stuck in this world where momentum investing is dead. Thank you.